when I think about growth, that's the very first question that I want an answer to for my clients and for us is, of your total addressable market, how many people are you reaching? Who knows you? Who even knows you exist? Because if they don't know me, it's like the pitch that I never swing at.
Welcome to the Value Factory Podcast, brought to you by One Accord. We're all about helping businesses thrive and grow through leadership, strategy, and meaningful impact. Now, whether you're a seasoned executive or just starting out, our goal is to provide insights and inspiration to help you navigate your journey. Thanks for tuning in.
Welcome, John, to our latest conversation in the series of the Value Factory conversations. And welcome to our new studio.
Yeah, that's great.
Awesome. Hey, I'm excited to have a fun conversation, a forward-looking conversation around growth. You and I have talked about several things that, kill deals or reduce enterprise value. Let's get into the things that every entrepreneur likes. It's growing the top line and increasing enterprise value. Talk about growth.
Let's talk about growth. Like that's one of your main things with One Accord.
That's right.
Is how do we help people grow?
Yeah.
And not just the top line, but especially the bottom line.
Grow the top, shrink the middle, grow the bottom. Yep. Our roots, dating back 25 years ago, were in revenue acceleration. There's a lot of ways to grow. We can attract new customers through marketing and sales. And we can buy new customers through acquiring strategic, another business. We can go into new markets. We can expand the share of wallet, as we used to say in banking, deepen our relationships. And I know you've assisted folks in growth through acquisition in particular. So yeah, lots to talk about.
And with what you do, I just want to say, think about companies, and there's different ways how you can grow. So if you look where we're sitting in your office, and you go down the hill, you got Sur La Table. You go up the street a little bit, you got Seattle Coffee Gear and Mud Bay for pet supplies. That's a marketing business.
Yeah.
But your business, my business, the accountant, the lawyer, that's a relationship business. Or even if you're selling parts to Boeing, you've got to have a relationship, because you're not going to market to them. No one's going to buy a part for the supply chain because they saw an ad for you.
Yeah.
But yet it's not relationship when you go into those stores I just mentioned.
Yeah. I actually needs a relative word. I would really like to buy a new coffee machine. The one that I have, I like a lot, but it's 10 years old. I got it from the Seattle Coffee Gear, as you mentioned. I will probably go back there, but I'm also looking at, Amazon and other retailers. And, I know the brands, and that's really kind of shopping on price. But if somebody put a special in front of me, a discount, right? Marketing, that would attract me as a client. In our business consult, this is interesting. I want to go down the rabbit trail of growth by acquisition, because I actually want to do that with One Accord. So that's a real conversation where you can advise me. But as we, like you say, professional service firms, I do some advertising. And I have not yet seen that advertising convert into revenue dollars. The digital ads, the print ads, and yet I'm not willing to just give up on it yet. I think rather than saying it doesn't work, I'm still in the camp of I just haven't figured out how to make it work.
Maybe, but you're selling a service that is very intimate.
Yeah,
I'm going to dig into your company, help you do better. If you have to, I just think if you're getting people that are coming to you, and I know this in our business, I tried Google AdWords a number of years ago because someone I knew got a client from. I got zip. I got the inquiries of What do you charge?
Yep.
Yeah. This is the last thing I want to talk about.
Yeah.
So, uh, I think it's different for every business. Whereas you take the companies we just mentioned in retail with a product, it's all get them in here, show them the quality, show them the pricing. But we have to get them in here. We're not going to get them in here by picking up the phone and calling every household and say, "Do you need a new cast iron?" Yeah, gotcha.
What you just said, I think is something we all know, but need to be reminded of regularly, which is it's different for every firm. How you attract clients is different for every firm. Industry, sector, firm, company, brand, yep, it's different. I see our primary growth engine is being, well, first of all, we have to be known. We have to be known. We have to understand what's our total addressable market. So how many people could we serve? And for us, that's in the United States. Do you go coast to coast?
We have, but mostly it's Northwest.
Okay.
And then it filters out from there. And then, but it's also who do you want to know you? I don't care if I'm known in the bankruptcy attorney world.
Right.
I don't need that.
Yeah. Who do you want to know you? Who do you want to know? Yeah.
I want to know people who are on the professional side, advisors who are dealing with lower middle market businesses.
Okay.
And they tend to be attorneys, accountants, sometimes bankers, but often they're the last to hear because they don't want to tell a banker I'm selling.
Yeah.
Pull the line of credit and whatever else. And consultants, advisors, coaches, EOS implementers, all of that, and it's just knowing enough people because let me tell you, our network, we got one referral every year from everyone in our network. We'd be so swamped. We wouldn't.
That's right. And so that network, and this is where, we have a Venn diagram that's almost completely overlapping circles in terms of the, folks that we want to know us in those network circles. How about the actual business owner? So your customer, the person that writes you the check, writes us the check.
Yeah. Or ACH these days.
I guess. Yeah. They click the button to send the money. For us, that person is generally the owner operator of the business. They are the decision maker. Sometimes it's the CEO of a privately held or publicly traded company, or an executive that might hire us for project work, particularly around growth. If we're looking at marketing strategy or sales enablement, et cetera. And so I could say confidently that there are over 1 million individual people that have the BANT, the budget, authority, the need, and the timing to hire us. Well over 1 million people. You think that's true for you also?
Yeah.
Yeah.
If I wanted to be completely nationwide.
Yeah. And I would say of those million, there are fewer than 10,000 that know us.
Sounds fair.
1% of my total addressable market knows me. And so I think, how do I reach the other 99?
Let me ask you about that 10,000.
Yeah.
Because the 10,000 don't necessarily need to know you, the firm, but they have advisors who have 100 clients, and that advisor knows you. You're one step closer.
Right.
And it's like a tree going.
Yeah. Yeah. So this is where we would go into, with a client in analysis. How do you get in front of your client, the person that would write? And so for me to try to reach 1 million people, I have to do that through advertising, social media, digital. Like, there's a lot of energy expended to get in front of 1 million people. Whereas if everyone that I talked to in the network advisor space knows 100 people, Well, then I can dial that back and say, I only need to talk to 10,000 because they'll talk to 100, and that will get me to 1 million. But here again, I need to be in front of and relevant to those 10,000 so that we're getting the timing right. So
And when you say I, you mean the collective I that's going in
thank you.
or just like
Yeah,
I say me and
I do.
yes.
I do. Yeah, I'm thinking of myself as being synonymous with One Accord. Thanks for the correction. One Accord, the brand, it needs to be in front of more people. That's when I think about growth. That's the very first question that I want an answer to for my clients and for us is, of your total addressable market, how many people are you reaching? Who knows you? Who even knows you exist? Because if they don't know me, it's like the pitch that I never swing at. That's it. So that's on growth, but that isn't the only way to grow. And oftentimes it's the least efficient, particularly in our business. I could spend all kinds of money for people to know me, but that isn't going to get me growth. Mm-hmm. Got to have the right people at the right time. Doug Hall, whom you know, he leads our strategic planning practice. And he said something to me that I just won't ever forget. I just won't ever forget. We sell vitamins. Our clients buy painkillers, and we cannot manufacture pain. We cannot manufacture pain. So on the sales side, so we just talked a little bit about marketing, but on the sales side, I've got to show up. One Accord needs to show up when that client is experiencing enough pain. Like they've worked with you or they've gone to you and they said, John, I'd like you to sell my business. And you say, Bob, I'm sorry, but I cannot sell your business right now. And Bob says, why not? We've had that whole conversation. And you might say back to him, you need to grow. The market is not buying businesses your size. You need to grow.
Or I say, Bob, you've told me you need to get X $1 million for your business,
Yep.
for your next great adventure in life, and it is not worth close to X $1 million.
Yep.
You need to talk to someone like One Accord.
You need to grow. You need to grow. What if Bob says to you, okay, instead of selling my business, help me buy another business because then I'll grow. I can double in size if I just buy somebody who's equal to me.
Yeah. So that's a great segue because
that was intentional.
Yeah. My last article for both of our websites was on this company growth by acquisition makes dollars and cents.
I love it. Who wrote that book?
I think I did.
I love it.
Yeah. And it's, I've got an article I brought along too, that some notes on here, but it's titled Growth by Acquisition Isn't for Everybody. Isn't. You don't do it for the sake of doing it.
Yeah.
You do it when you can't grow fast enough or you need a different geographic market and you say starting one is going to drain a lot of money. Mm-hmm. Whereas if I buy one, yes, I put money out, but immediately get cash flow that starts paying it back.
Yeah.
And, and other things, just growth for customer sake or finding the right people. I need more people.
So what you just said, I need more people. I use the term acqui-hire. Have you heard this before? It is an acquisition to hire a team, an acqui-hire. And I actually look at myself as being an acqui-hire. Jeff, owner, founder of One Accord, acquired the firm that I had started, my brand, but acquired me. So in the last 2 years, One Accord actually acquired 8th Avenue Advisors, my firm. Mm-hmm. And I'm looking at doing that again. And we have some strategic partnerships that could evolve into formal acquisitions where the company that, one of our folks started becomes One Accord, where that company no longer exists and the clients of that company become One Accord clients, and how we might do that. Is there a way to acquire a company without a cash payment?
that is a great question, especially these days. I have on my bookshelf a 40, 50-year-old book called like buying a business with no cash or something.
Yeah.
Uh, and I'm going to tie it into the next part, when I've read through the book, what I remember is, yes, it's really possible if you are buying a crappy business.
Yeah. That there's a several conversations that I follow. My social media feed is full of business strategy stuff. Go figure, right?
You know,
And so many conversations about buying boring businesses from boomers.
yeah,
This is the thing. And then there's the whole story of just, pick up the laundromat and tech enable it and you're going to make money in your sleep. And I
yeah, to roll my eyes.
seriously, like, okay, those are good hooks, but is it even possible really to buy a good business without cash? And I think the answer is no.
I definitely say it's no.
Yep.
I do know there's a lot on the internet. There are well, quite a few out of England promoting buy a business with no money, none of your own cash, setting up mastermind groups, and they feed each other.
Yep.
And they really don't know what they're doing. Why would somebody with a good business sell to someone who has no money?
It just doesn't make sense.
It doesn't make sense. So why a bank won't lend?
Yeah.
Banks have minimum, yes, requirements, but yes, there are SBA conditions where a buyer doesn't have to put in anything, but an owner has to be pretty desperate to sell to them because they end up having to have not only a completely subordinated note, but also on standby. And if they do it that way, they firstly guarantee the buyer's note with the bank on an SBA loan.
Wow.
For at least a couple of years, if not longer. And if you go to a non-SBA loan,
Okay, so this is great. Cap stack, how you buy at least 25% down from a bank.
from bank.
But that 75% that a bank is willing to advance. So let's just say simple numbers. I'm going to buy a business for $10 million. I could have said $10 million. So I'm going to put $2.5 million in cash into the deal. And there's going to be a bank that's going to loan me $7.5 million.
Yeah, they might loan you 6.5 and the seller cares, for another million or something like that. Because you're at 10 million, you're pretty much out of the SBA loan range. So it's going to be a conventional loan.
Okay.
I'm going to put down 25%.
Yep.
And have 7 years to pay it off.
And but there are other limitations in that it's not just that the bank wants a certain down payment. It's not like buying a house where like, oh, here's the sales price, here's the down payment, slam dunk. There's also financial metrics of the business that are taken into consideration. You can't, and leverage ratios come into this.
Coverage.
Yeah.
Your debt coverage ratio. In other words, you are a banker.
Yeah.
So here's your profit. Here's your principal and interest. You better have enough here. And while some banks may say, we'll go down to 1.2, 1.15, whatever, you really want to be at 1.5. So $1 million of profit, $2 million of profit, you want to be at $1.5 million or $3 million respectively, because that cushion is what you have to pay taxes. You have to use it to grow the business.
Yeah.
If you have investors that are requiring something to come out every year to at least cover their taxes.
Yeah. I said it when I was a banker, I would say it this way. If for every dollar in debt that you have to pay, principal and interest, for every dollar of a loan payment, you want to be making at least $1.25, but probably $1.50 or more.
I say on an acquisition loan, $1.50.
Yeah. I think that's sound. And that's even, on my side, if I'm buying a business and I'm taking on debt and I'm basing all of my, everything's based on projections. It's a pro forma. I'm guessing at the future. I don't want to be as skinny as, on my pro forma, just $1.25. around 1.5.
Banks are going to run stress tests.
Yeah.
What if things go down by 20%?
Right.
Oops, where am I?
I'm outside of the work that I do at One Accord. I'm also a private equity investor, and I've invested in some businesses, and uh, they don't always perform the way that the spreadsheets indicate they should perform. Don't always. Nope. Yep. I think rarely is more accurate. Yeah. So, okay. If I want to buy a business that's a good business, I'm probably going to have to put some cash in. So let's not believe this mystery, the mythology that you can grow by acquisition with no money.
For a good business.
Yeah. Now, there are businesses that can be acquired without cash, but those are going to be very small solopreneur, and the seller of the business just knows they're not getting a check, but they're getting some kind of an earn out or payout over time.
It doesn't have to be a solopreneur. It could be a business with a dozen, 2 dozen employees, but just isn't performing.
Yep.
And and whether there's cash or not, there might be cash for the assets.
Yeah.
But otherwise, it's just pay for performance. And the seller's sitting there going, "What else am I going to do?
No other option."
But I'm going to write me a big check when I'm ready."
But I want to buy a business that's profitable, that's operationally sound, things are going well, because this is going to help me grow faster. Potentially the 1 + 1 = 3 scenario comes into play. There's some strategic vertical integration. I'm going to need cash. The seller might finance some of it, but I would be advising sellers to finance as little of it as possible, because they want, as much cash out as they.
Depends on the price.
There are considerations. There's some tax considerations, some timing considerations, but that just creates risk for the seller if they don't, have cash, and there's a risk premium.
Yeah.
You have thoughts on that?
Yeah. I mean, yes, the timing of the taxes does play a part for people. And if there's some misunderstanding out there. I mean, we have a client now who just can't get it out of his head. He thinks if he doesn't get capital gains rates are not like ordinary income rates, that they have a scale that goes up. So he says, I want to spread it out. I don't want to pay more taxes. Well, no, you just pay the same rate. It's just going to be over the next bunch of years.
Yeah.
And, but the other thing is, if in a situation where you get a good buyer and maybe there's some upside for you with an earn out.
Yeah.
Or you've retaining some equity, the buyer might say in a situation and your business is worth 10 million. And you want 9 million in cash. Look, I'll give you 10 million and 9 million in cash, but I'll give you 11 with 8 million in cash.
Mm-hmm.
And if the seller thinks, I'm going to be around here transitioning for a while, how long is it going to take them? Even if they screwed up, it's going to take a couple of years. I'm still going to get my 9 million, and that upside isn't very risky. So every scenario is different.
Every scenario is very different. And I can't say that I have an opinion one way or the other on anybody's deal. But I think generally speaking, if I'm selling the business, I'm intending to de-risk and deleverage. So I'm going to want all cash or enough cash that the rest that's put it at risk doesn't. But on the acquisition side, I'm going to be looking for the very most favorable terms. So I want actually as little cash out of my pocket as possible, because I want to hang on to cash to invest in the business, to have dry powder, to weather the storm. So as little cash out as possible, as much bank or seller financing as possible. And so then the bank is going to be looking at cash flow ratios, debt to EBITDA, debt to tangible net worth. There's a lot of constraints that come there. Yeah. So I might be looking at an acquisition scenario where I've got multiple capital providers. My business puts cash in, the bank puts cash in, a mezzanine lender comes in behind the bank, the seller offers some note or carry back, and then I I have a lot of people to pay back. Um, why on earth would I want to do all that?
Well, I'll give you a reason, because it's a lot easier money than if you walk into the bank and say, I want to open up a new division and I want it to be in Portland or Denver, and it's going to cost me $2 million to do that. And here's my projections. And just like you said, projections, okay, but are you really going to hit that from zero on up?
Yeah.
And will you lend me that $2 million? And the banker's going, it's your collateral.
Uh-huh.
And then you got a lot of risk versus I'm going to borrow $7 million and I have cash flow that's been proven over the last bunch of years, and the business is going up a little every year.
Yeah.
And it's going to pay that back out of that, not out of my pocket. And when I hope it works.
Yeah. So I have a shorter, there's a shorter distance to travel to there being revenue. So if I'm going to grow organically, I got to go find clients. I got to find new sales. Now I may not have the expenses up front as I do with a fully operating business, but if I'm trying to grow organically, I'm going to have expense ahead of revenue, generally speaking. I'm going to hire people. I might have a physical location, unless I've already signed a contract that brings me into a new market, which is a great way to grow. If I'm looking at these two
But
things.
it's still going into a new market. Still is.
Yep, that's right. And so in order to finance that, I'd have to have very robust operations in my existing business, sufficient to support additional debt. Like basically, I'd have to be able to pay for it from my existing business.
Yeah.
But if I'm growing through acquisition, that new kind of add to assets, add to revenues is going to allow me then to finance that transaction to a greater degree.
That's right.
Yeah.
Because it has the payback built in.
Yep.
And there's a couple advantages too on the growing by acquisition. Again, it's not for everybody, but if it's for you or collective you out there,
Mm-hmm.
there's I call it the yes we can. That you bought a business, you integrated it, it's done well. Other acquisitions could be on the way. I have a past client. He's bought 4 businesses in one industry, and the last one came to him because they saw what he did with the first 3. And simple terms, they said, we've seen what you've done, working for you. You're our buyer. Will you buy us?
Brilliant. So, I mean, you've said it. Growth by acquisition isn't for everyone. And I've wanted to ask you each time you said it, okay, who's it for? So you just gave me a profile of somebody who's done it once, done it twice, done it 3 times. So that person, that Bob, I call him all Bob. It's just easy. So Bob he's got the temperament, he's got the strategy, he's got the resources to do this.
Yeah. Or to go out and look for one. And a lot of people would say it's safer to sell to someone who's already up and running in your or a similar industry than
well, so that's
a smaller side, the individual buyer, and maybe better than I had breakfast with someone yesterday who sold to private equity, and he said, "You got any of your clients that are interested, thinking they're going to sell to private equity, have them call me first." He got paid, but it was not a placeable experience for him, and especially for his employees.
So I'm hearing that more and more. The private equity firms that we are connected to, I think they operate differently than the kind of the private equity firms that show up in the social media feed.
He sold to a really good size,
yeah,
private equity back that eventually went public.
Yeah,
but I guess there are smaller private equities to the low and middle market.
So this is a question that I wanted to ask also, which is, as you are taking a company to market, you're going to represent someone in a sales transaction, do you look for other strategic or affiliate kind of aligned folks that are on an acquisition? But before we go there, I want to go back to this. Like, talk to me about Bob that is the right person to grow by acquisition. What characteristics, what temperament, what skill set does someone who you've seen be successful at growing by acquisition, how would you describe them?
They have a business. They would like to grow faster than they are, and the organic way is too slow for them for
Okay.
their plan. They want to get into new markets. They need certain type of people, uh, and they have the bandwidth that they're not working in the business too much.
Good.
They're an owner dependency situation.
So they're that's really good. They've got bandwidth. They're not working in the business, so they can be in that kind of higher level strategic. Yeah. Okay. Um, they need financial background. They need to be strong operators.
Or they have a CFO.
Okay.
Yeah.
Good.
I mean, we're not necessarily talking about someone who's doing it all. Someone can't be the CEO, COO, CFO.
Yeah, because otherwise they are in. Yeah, they got no time for anything. What about personality, leadership style? Like, bringing together two firms. Uh, in banking, I went through no less than 5 acquisitions. I've not counted them recently. I think it's 6 or 8 acquisitions. Every single time, the 2 CEOs said, we are doing this because our cultures are aligned. And the first time I heard that, I was a young banker and I was like, oh, this is so great. Our cultures are aligned. And then it happened. I was like, what part of cultural alignment did you guys see? And then over time, I just realized that this has become the talk track. This is what they say.
The one-year-old banks acquire another one a couple of years ago, keep the acquired's name to please people.
Yeah.
And then now they're going back and the cultures didn't align in all departments.
Yeah. And I look at that bank and that bank's management team as being exceptional. Like, I really do. I have very high regard for that bank's leadership team. And I also think, like, no, it's not culture. No, that's not it. This is a financial decision.
Oh, by the way, we use different systems for just about everything.
All of it. Yeah. Oh, okay. I mean, listen, so this is too much detail, but we are becoming a Zoho implementation partner. Zoho is a leading. Yeah. Okay.
UCR.
Yep. And we are going to convert from our current CRM platform to Zoho. And I'm already breaking out in like allergic hives around a system migration, a data migration. Growing by acquisition. You've got accounting systems, you've got inventory systems, you've got HR systems, you've got CRM systems. Like, how long is that list?
Yeah.
So it's not just a question of, oh, well, they do something that's cool and there's revenues, I'm going to go buy them. Got to bring people together. Got to bring systems together. You need a CFO that's going to bring financials together. You need a CTO that's going to bring technology together. You need a chief people officer that's going to bring people together. Some people are not going to fit. Some people on the acquired team are going to be a better fit than people on the existing team.
And hopefully they stay. And I will tell you, the last handful or so of deals we've done, the client put in a retention bonus program for their key people, but it paid out. I think the earliest one is paying out in 1 year. They have to stay a year and get in there, and by then, if they're going to stay, they're going to stay. They're not going to stick around. If they don't like it, they're not going to stick around for a bonus.
Yeah, it's good. In the article that you wrote, that you've mentioned, are there? I this isn't the right way to say it, but tips and tricks or, clues and cues that we should be looking for around growth by acquisition?
Yeah, I just said a couple of them that, if the organic growth is going to be too slow for what you want.
Hmm.
And sometimes that means you have very talented people. And if you're not growing fast enough, they're not seeing career advancement.
Interesting.
So if you buy another company and you're larger, they can move up a level or two.
Yeah. A really thoughtful assessment of the team should be a part of the diligence on. So I'm just thinking, if I'm going to grow by acquisition, and I intend to over the next 3 years, because we want to be in other geographies and in other industries with our model. If I just run through the future, we will become a partner-owned firm uh, in a short window, and then I would hope that we could attract some institutional money to become a platform organization that would grow by acquisition. So fully aligned with this growth strategy. Um, if I have people on the team today that have capacity to help us grow by acquisition, that's a green light, green flag. But if I don't have anybody on the team that can help blend cultures, blend technology, blend finance, I'm asking for a world of hurt.
Yeah, you are.
Yeah. Yeah. Um, the,
But
yeah,
go ahead.
please. No.
I was going to say, let me flip that what we're talking about when I said, yes, we can do it to show for future, but it also affects the next step, which is exiting. That you can say, look, we made an acquisition or two or three. We've done integrations.
Yeah.
To be able to integrate us easier, larger company.
Okay. I wouldn't have thought of that. We have a leadership team that's been through these integrations. We understand this side of it. That's good. How about this one? Working with a client today, existing, like actual real Bob. And I'm going to just say numbers that, just for orders of magnitude, he's at 100 million in revenue and he wants to go to 200 million in revenue before he exits. So how are we going to help him get there? Could be acquisition, could be organic, could be both, could be, right? One of the careful considerations that we have to make with Bob is, if you want to sell your company in 3 years, but you want to double the size of your company in 3 years, probably going to have to acquire. If you're going to acquire, what does that do to the financial performance in these 3 years before you want to sell?
Well, even if it's not my position, you say, I want to double this company and then exit in 3 years. How are you going to do it? Well, we're going to have to hire about 30 more people. Or 30 more people at 6 figures apiece. That's every year.
Yeah.
And then they're not productive right away. So it's all of that.
So the math, and this is where, we bring in the, I forget what it is, right brain or left brain, which is the one that does the math. I think I don't know. We bring in the math brain folks. I should know that because I'm one of those people. And we just say, okay, here, let's run it out. Pro forma, 3 years from now, if you spend X on an acquisition, on marketing, on hiring, what does the P&L look like? What does EBITDA look like 3 years from now if you hit all those numbers perfectly? And is there a story in there that says, hey, we went from 100 million to 200 million with this management team. We acquired 3 strategics. We are now a platform company. So as I go to exit, if I'm going to sell this business, the buyer is taking on a management team, to your point, that has been through acquisitions and with additional capital could go acquire more, go from 200 million to $1 billion with a team that's done. But that buyer is also going to look and say, okay, but you've had significant expense over these 3 years. We can try to justify it as non-recurring or one time, but it's not, because this is the growth play.
You want to keep growing after.
You're gonna have to keep spending.
Buying the vehicles or the machines or
Yeah.
hiring the people.
Yeah.
Very, very few businesses can go from 10 million to 20, 100 to 200 and, say, well, we don't need any more people.
Right.
Yeah.
Now, okay. So the other question I wanted to ask you, and we're, this is a fun conversation.
Yeah.
The other question I wanted to ask is, as you are, so if I came to you and, John, help me market One Accord for sale. Would you look to other consulting firms that have acquired? You'd look for somebody that's, potentially a strategic, or would you look for somebody who's an owner operator that just wants to, kind of replace me? And, how does the conversation of grow by acquisition impact someone wanting to sell to someone growing by? You follow what I'm saying?
Yeah, I do.
Yeah.
And it all depends on your, I want to say it could be any company, but
Yeah.
your size at the time and what you've been doing. If you take an advisory firm that say is doing 10 million a year and you want to find a buyer, well, you're not going to sell to one of the big four accounting firms. You're probably too small. 98% chance you're too small.
Yeah.
And so your market is not up here, it's here. But if you grow that business to 20, 30 million, all of a sudden you lose these buyers, but you gain maybe not as many up here, but maybe more serious buyers who can just do it.
That's such a good point. More serious buyers who can just do it. People who've done it before, they can just do it. So I'm, here again, on my spreadsheet, sometime in the next 3 years, I imagine acquiring, really small consulting practices across the country. And I'm talking about less than 5 people.
With the same focus in One Accord of increasing value and providing growth?
Yeah.
Okay.
Yeah.
Not into HR, not into...
No, good point. Yeah. I'm not interested in, expanding our, I don't want to go into HR. I don't want to go into fractional CFO. I want to go deeper into the things that we do. So for example, we have, an industry focus. We have a practice area, industry focus on, financial institutions, banks and credit unions, where we do strategic planning, sales enablement, sales strategy, which really a growth revenue play. There are dozens, if not hundreds, of small consulting shops that do strategic planning for banks and credit unions across the country. And they will stay the size that they are, and they have clients, but they're entirely owner dependent. And it's the owner and maybe a couple of...
Isn't that one of our last podcasts, a couple podcasts?
Yeah, it is. And so, my acquisition strategy is really to say to these folks, like, join our platform, come in here, and there's actually an equity play. There's an opportunity to be an owner of something that is going to live longer than a business that is entirely dependent on one person.
And you take away all their administrivia they have to.
There's some upside there also. And the idea here is that, they can continue to serve clients. They don't have the admin, but then they get ownership in something that will grow and last. Right. And so that's
the second bite of the apple, like when there's rollover equity in a deal.
Right. But it's really creating equity. It's providing equity in something where they have 100% equity in something that will have no value at some very defined, right? Or to trade that 100% equity for some, fraction of equity in something that will be, right? And I'm reminded all the time of, like, Jensen Huang of NVIDIA and Jeff Bezos and Elon Musk. They own each of those those multi-billionaires own single digit or low double digit percentages of the companies.
Yeah.
Right. Back to the growth by acquisition is, there are folks out there that would love to sell to firms that have been growing by acquisition, but those firms have now grown up to where they're now attractive to the bigger buyer.
Yeah. And that's going to be my closing point on this. And I'll start off with an example, because we've been working with a company that, we did it as a favor to somebody that referred us in, and we made real clear this is a challenge. And given that the founder had died, the family's been running it, and we have a couple people interested. And one is a company out of the Twin Cities, and they've made 40 acquisitions, and they are making 2 more that they say will get them, like, is it to 100 million something? But this one is very small for them, but it's a field they want to branch into, because right now they're very narrow. Everything is in this channel. Something happens in that channel.
Yeah.
But it brings up consider them, and if they're growing, say they grew from very small to 100 million. When you make acquisitions, the bigger you are, the better when it comes time to exit, because you're not only say you're making 10%, if you're making 10% on 10 million, 50 million, 100 million.
Right.
But when you get up, the multiple of those earnings goes up too, because you supposedly have more infrastructure, more management, less risk, things like that.
Yeah.
So the bigger you are, the better. You're not only going to have more income to base the multiple of earnings on, but you're going to higher multiple of earnings. So it's a double whammy. Good double whammy.
Yep. It's a good point. Good one. A lot of reasons to consider growth by acquisition, and an equal number of reasons to not do it. Are there answers in your book about should I or should I not?
It's not just this is a one size fits all. It does go into some of that. It gives it reasons why, and you better be in the right position too.
Yeah.
And there's some people who I talked to someone, and we're going to start doing a little bit of work with them, not on acquisition, on some coaching on a couple things, and to lead up to their exit. What do they say is 2 to 3 years away, because they feel their husband and wife, they feel their industry will be really good position for them to sell in 2 to 3 years.
All right.
And we talked about this, and nope, too close to wanting to get out to want to do it now. That's a great reason.
Yeah.
Don't want to manage any more people.
Yep.
Then you're setting yourself up for, as you grow, that you're going to have to sell to somebody because you don't want to manage more people. But we sold a business a year and a half ago, closed. Not many people in the company, 10, 12. Owner made it real clear from first meeting over coffee. I don't like managing people. I don't want to manage any more people. We have so much business in the pipeline.
And that was the person selling?
Yeah.
Yeah.
He said, I got into this to do the work, and I'm really good at doing the work.
Yeah.
Yes. He's phenomenal.
Yeah.
He says selling and client strategy, etc.
Yeah.
Doesn't want to manage. He said 10 people is more than I want to manage.
Yeah.
Had a nice, the guy was making over 50% net margin in the service business.
Yeah. Good job. Good job. Awesome. John, thanks for, I guess, what do we say, that christening the new studio here, the Value Factory
Studio.
Yeah. Enjoy our monthly conversations. We'll have folks look forward to your blog post on growth by acquisition. It isn't for everyone.
That's not the title of the one I sent you.
Yeah.
But it's been up on my website. I don't know when it's going up on your website. So
it'll be up by the time this episode airs. So we're all there. Okay. Thank you, John. And thanks for tuning in to the Value Factory. We'll see you again soon.